Gross income includes all compensation for personal services. The form of the payment is irrelevant. If services are paid for in property, then the property's fair market value at the time of the receipt is considered to be gross income. Income from self-employment is also included in gross income. Unreported compensation, for example, tips, is also included in gross income. And then income, such as interest on savings, is considered received when it's made available to the taxpayer. Types of income that are included in gross income are business income, compensation for services, which includes fees, commissions, fringe benefits, and so forth, gains from dealings in property, interest, rents, royalties, and dividends. All of these are types of income that are included in gross income. Other types of income that are considered to be included in gross income are annuities, pensions, partnership income from a 1065 K1, income from an interest in an estate or a trust. 1041 tax returns generate K1s which have to be reported on an individual tax return. Alimony. Differences between taxable and non-taxable income include non-taxable income is considered to be excludable. These are gifts and inheritances, insurance proceeds, sickness and injury payments, welfare payments, and food stamps. All of these are considered non-taxable or excludable income. Taxable income, which is considered earned income, is received for work, such as wages, your W-2 that you receive from your employer. Business income. Unearned taxable income, some examples of that would be interest income on a savings account, stock dividends, and rental income if you own rental property. This is taxable income that's considered unearned. What about Social Security? Well, it's considered unearned, and a portion may be taxable depending on other income that's reported on the tax return. What about unemployment? Well, it's considered unearned, but it's all taxable. The total of earned and unearned income is considered to be gross income. So let's take a look at some examples. Wages, of course, they're considered taxable. Interest, considered taxable. How about child support? Child support is considered non-taxable income. Alimony, we just saw a few moments ago that it's taxable. Inheritances, non-taxable income. Workers' compensation, considered to be non-taxable. How about lottery winnings? Oh yeah, it's taxable. The W-2 form is typically issued to employees by January 31st. This W-2 reports wages and other compensation, and here's an example of a generic W-2. You would report the amounts in box 1, the wages, tips, or other compensation, and typically that's going to end up on line 7 of the 1040. Now on your W-2, there's a box 12. Let's take a quick look at what the codes and the amounts in box 12 of the W-2 can mean in certain circumstances. The codes and the amounts in box 12 of the W-2 are important in preparing a tax return. Some codes affect the current year income tax return, and other codes are simply there for information. So if we look at this W-2 in box 12 or 12A, we see a code D and an amount of $2,000. Well, some of the more common codes in W-2 box 12 are code A, which represents uncollected Social Security or railroad retirement tax on tips, you would include this amount as part of your total tax on Form 1040. Code B is considered to be uncollected Medicare tax on tips. You would include this amount as part of your total tax on the 1040 as well. Code D, which we just saw, is a non-taxable elective salary deferral to a 401k or a retirement plan or a simple 401k. Code DD reports the cost of non-taxable health insurance provided through your employer. This is a fairly new code, came about as a result of the Affordable Care Act. Code Q. Military will be familiar with this one. It's non-taxable combat pay. Some individuals may elect to include this combat pay when calculating their earned income credit if it turns out to be a benefit. And Code J, non-taxable sick pay. And again, these are the more common codes that you will see in Box 12. On the 1040, you would enter the wages, as we said, from Box 1 of the W-2 on line 7. So now let's move to taxable interest in Schedule B. Taxable interest includes interest that you receive from bank accounts, dividends that are actually considered to be interest, mostly from credit unions. Credit unions often call their interest dividends. CDs, certificates of deposit, and interest on insurance dividends. Interest you receive on tax refunds is included in interest income. And installment sale payments. If you sell property or a house on an installment sale method and you receive interest from the installment sale, that would be considered interest income on your tax return. Non-taxable interest includes interest on U.S. Treasury bonds and savings bonds. They're taxable on your federal return, but tax-free at the state level. Interest payments on most municipal bonds or muni bonds are tax-free at the federal level. What about interest from a traditional IRA, an individual retirement account? Well, interest earned on a traditional IRA is tax deferred. You don't include that interest in taxable income until you start making withdrawals from the IRA. Here's a typical 1099 INT. Interest income is generally reported on this form. If the total amount of interest that you receive is more than $1,500 in the tax year, then it must be reported on Schedule B. Schedule B, the total, then transfers to line 8A on the 1040. Although tax-exempt interest is not taxable, it has to be reported on your Form 1040. Tax-exempt interest often shows up in Box 8 of the 1099 INT. This interest gets used in calculating the taxability of certain income items such as Social Security benefits, and that's why it needs to be reported. Examples of tax-exempt interests include bonds that are issued by state and political subdivisions, county or city. For example, let's assume that David Shoemaker purchases a municipal bond. The bond pays 5% interest per year or $50 for every $1,000 that David has invested. That $50 is income to David, which is normally taxable. However, because municipal bonds are tax-free securities, David's interest is tax-exempt. In some cases, the amount of tax-exempt interest a taxpayer earns can limit the taxpayer's qualification for certain other tax breaks. Again, municipal bonds are the most common instruments for paying tax-exempt interest. However, some interest from certain savings bonds can be tax-exempt as well. Tax-exempt interest shows on Form 1040, line 8B. Next, let's move on to dividend income and distributions. Dividends are distributions of money, stock, or property paid by a corporation. Most corporations use Form 1099 DIV to report dividends and distributions. The total ordinary dividends will appear in box 1A. Ordinary dividends then show up on Part 2 of the Schedule B. And then they flow to line 9A on the Form 1040. So, just to review, we've got taxable interest on line 8A, tax-exempt interest on line 8B, and ordinary dividends showing up on line 9A. Qualified dividends appear on line 9B of the 1040. On the 1099 DIV, you'll notice a number of boxes, some of which may have amounts reported in them and others that are left blank. Each box reports something different and affects whether or not you must report it on your tax return, as well as where to report it. Total ordinary dividends, again, appear in box 1A. Keep in mind, this is a generic 1099 DIV. Some corporations, their 1099s look a bit different than this. Qualified dividends, again, appear in box 1B on the 1099 DIV. And total capital gain distributions often appear in box 2A. Non-dividend distributions can appear in box 3, and exempt interest dividends appear in box 10. Specified private activity bond interest dividends, you may run into this somewhere down the line, appear in box 11. Well, after all that, you'll probably say, well, that's just fine and dandy, David, but how do I know where to put these particular figures on the 1040? How do I know where to enter them? Well, if you take the 1099 DIV and you flip it over on the back, there are instructions that tell you what to do with each box. For instance, box 1A, we're told to enter that amount on line 9A of the 1040. Box 2A, we report these amounts on Schedule D, line 13. Box 11, we're told that this amount is also included in box 10, and it's an alternative minimum tax item. We haven't talked about this yet, but we may need to put this on Form 6251. Anyway, short story is, on the 1099 DIV, if you have any questions about where the figures are entered in each box, just simply flip the form over and it'll give you some good hints. All right, here is a 1099 DIV, and this 1099 DIV has qualified dividends entered in box 1B, $34.99. Notice the ordinary dividends and the qualified dividends in this case are the same amount. Now, since 2003, certain dividends known as qualified dividends have been subject to the same tax rates as those for long-term capital gains. These tax rates are lower than the rates on ordinary income. The IRS says that qualified dividends are dividends paid during the tax year from domestic corporations and qualified foreign corporations. For instance, this means that regular dividends paid out to shareholders of companies that are listed on the New York Stock Exchange are usually considered qualified dividends, and they're taxed at the reduced capital gains tax rate. In other words, you'll save money, you'll save tax money on these qualified dividends. For example, Assume that John owns 10,000 shares of Google stock, which pays 20 cents per year in dividends. So in total, John receives 10,000 times 20 cents or $2,000 per year in dividends from Google. Because Google pays qualified dividends, John pays the capital gains tax rate. Let's say, for instance, 15% on the dividends rather than ordinary income tax rates, which could be 35% on the dividends. The most important thing to remember about qualified dividends is that they're a category of ordinary dividends subject to special tax rules that can save you or your clients money on the tax return. In other words, all qualified dividends are ordinary, but not all ordinary dividends are qualified. So we look back at our Schedule B. Dividends show up on Part 2 of Schedule B. And the $210 dividend that we previously entered adds to the qualified dividend from the new 1099 DIV that we entered. When qualified dividends are included in a taxpayer's income, the income tax is calculated differently than under normal circumstances. Ordinarily, a taxpayer will pay income taxes based on the figure that's obtained from the tax tables that are found in the 1040 instructions. So let's look at our taxable income in this particular example, $43,059. The income tax on line 47, $4,311. However, the tax from the tax tables, if you were to look these figures up, $5,534. And again, the tax calculated on the return, line 47, $4,311. Big difference. Why? Well, again, looking at the tax tables, married filing joint for this particular return, $5,534. When qualified dividends and capital gains are included as income on the return, the federal income tax is calculated on the qualified dividends and capital gain tax worksheet. The final outcome of the math occurs on lines 26 and 27 on this qualified dividends and capital gain tax worksheet. So in summary, all compensation for personal services is gross income. The form of the payment is irrelevant. Non-taxable income can include gifts, inheritances, welfare payments, and food stamps. Social Security payments are considered unearned. However, a portion of the payments may be taxable depending on the other income on the tax return. Unemployment compensation is considered unearned but is taxable. Interest earned on a traditional IRA is tax deferred. If the total interest income received is more than $1,500, then we have to fill out another form, a Schedule B. Qualified dividends are a category of ordinary dividends that are subject to special tax rules. Income taxes are calculated differently when qualified dividends are included with the other income on a tax return. Next, let's go over some review questions.